What are the non-discounted or non-discounting models of payback period and the accounting rate of return? Well, to begin with, the payback period is simply the amount of time that it takes to recover all of the capital invested into a project or business. So if I invest $10 and it takes 2 years to return that money, then that is what I'm calculating, how long it will take to get that money back. I would be earning $5 a year before I earn $10 back. Okay, now generally it's the amount you invested divided by the annual cash flow. Now, payback period can be discounted or undiscounted. Most of the time you're going to do a discounted model. Why? Because money in the future is worth less than it is now because of inflation and then the opportunity cost associated with your money. So you will need to discount your future cash flows to get the present value of those future cash flows. So that makes it so the formula for calculating payback period is a little more complicated. That is, you're discounting the future cash flows and then adding them up. But with that being said, if you're going with an non-discounted or undiscounted model, which would generally just be used for a quick back of the envelope, as they say, calculations to see when you'll start making a positive return on the investment, then you would do the non-discounted version. Now, the accounting rate of return. This is another metric that is normally discounted based upon a rate of return. But if you're looking at the undiscounted model, what you're going to do is you're going to take your average net profit from the activity divided by your average investment. Now, why do you take the average? Well, the average net profit is simply the total profit over the period of time. Since you have multiple periods that you would normally be discounting, even though in this case you're not, you take the total profit over the periods. This is very important because you'll have varying levels of cash flow throughout the periods as well. You'll take the average over that entire period of time, so you get the amount of profit on average per period, and you divide it by the average investment. Sometimes you make investments at different rates throughout a project. So your average investment is the value of investment at the beginning and the value of investment at the end, and divided by 2, right? That's the average over the period. It's a very simple way of calculating that. And you divide the two, average net profit divided by average investment over the period. And that gives you, once again, your rate of return on the investment, or how much the investment has paid you back. And because it's undiscounted, you don't have to consider using a discount rate or a discount factor to bring those present cash flows back to present value. You use this simple calculation again as a quick, easy back of the envelope calculation for analyzing or evaluating a potential project or opportunity.